Hello! In this video, I will cover short-term notes payable and accrued liabilities. A short-term note payable is a note that has a maturity date that is less than 12 months from the issue date. An interest-bearing short-term note payable carries an annual interest rate in which the borrower will incur and pay interest in addition to the principal. Let's take a look at this example. On October 1st of 2021, Marathon Corporation borrowed $100,000 from Pacer Bank. They issued a 6-month note payable with a 10% annual interest rate. On the date of issuance, Marathon debits cash $100,000 and credits notes payable $100,000. So they have received cash from the bank and have incurred a current liability for this short-term note. Now it's important to pause and note that on an interest-bearing note, the interest rate that is stated on the note is always expressed as an annual amount. So if this note were outstanding for a year, the Marathon Corporation would pay $10,000 of interest. However, this is only a 6-month note. So when we compute the total interest that Marathon will incur on the note, that annual amount must be prorated by the length of maturity of the note. This note has a $100,000 principal balance. The annual rate of interest is 10%, but the note is only a 6-month note from the date of issuance to the date of maturity. So we prorate the annual amount by 6/12. The total interest that Marathon will incur on the note is $5,000. However, the note is issued in one reporting period and matures in the next reporting period. So the $5,000 of interest has to be allocated and accrued to the first reporting period for the 3 months that the note is outstanding in 2021. So 3 months proration on this interest amount is $2,500. $2,500 will be allocated and accrued in 2021, and the remaining $2,500 of interest will be allocated to 2022. So let's take a look at the entries that Marathon will make to accrue the interest in 2021 and repay the note in 2022. And we will look at the changing balances in the 2 current liability accounts that are associated with this interest-bearing short-term note. On December 31st of 2021, Marathon will accrue the amount of interest related to the 3-month time period that the note was outstanding. $2,500 will be debited to interest expense, thus having it reported as an expense on the income statement for the year, and crediting interest payable. The interest payable represents the amount of interest that they have incurred but not yet paid. Note that we are not increasing the note payable by $2,500. We are recording it in a separate current liability account. The interest due is separated from the principal amount that's due. On March 31st, when the note matures and principal and interest are to be paid, Marathon will record as a debit to interest expense the additional $2,500 of interest that is to be allocated and reported on the 2022 income statement. The interest payable that was accrued at the end of 2021 is now being repaid, so we decrease the payable with a debit, leaving a zero balance in interest payable. We also debit the note payable, decreasing the note balance down to zero. And finally, they will credit cash $105,000, which represents repayment of the principal amount of $100,000 plus $5,000 of interest. Now let's look at that same note, but this time it's a non-interest bearing discounted note. When we have a non-interest bearing note, the note is discounted up front and the borrower receives a discounted amount of cash. The discount is calculated the same way that we calculate the interest expense. We take the principal amount times the annual, now we call it a discount rate, and prorate it by the length of the note. So the discount on this non-interest bearing note is $5,000. When Marathon issues the note, they are only receiving $95,000 now from the lender. The other $5,000 is debited to a contra liability account called discount on note payable, and the entire maturity value is credited to note payable. We don't view this as a principal amount anymore. It's the maturity value, because in actuality, the principal is only $95,000 and the discount represents the future interest that Marathon will incur on the note. So substantively, this $100,000 is both principal plus interest. We call it the maturity value. So upon issuance of the note payable has a credit balance of $100,000, but we have a contra liability of $5,000 that in actuality reduces this note down to its carrying value of $95,000. On December 31st, Marathon will also incur interest expense. They will accrue $2,500, representing 3 months of interest, but instead of crediting the interest payable account, they will now decrease the discount on the note payable. This $5,000 represents interest that will be paid on the note. So they have incurred $2,500 of it in 2021, so that decreases the future amount that is left to be incurred. At the end of 2021 now, our carrying value on the note is $97,500. The maturity value of $100,000 less the remaining discount on the note payable. On March 31st, when the note matures, the additional $2,500 of interest is debited, and we credit the discount on the note payable account to bring the remaining discount down to zero. And now the note's maturity amount is paid off. We debit the note payable and credit cash, bringing the note payable balance down to 0. When we have a discounted note, like the previous example, the effective rate of interest is actually higher than the stated rate on the discounted note. Remember, the stated rate was 10%. That's how we computed the discount. But also remember that Marathon only received $95,000 in cash. That represents the true principal amount they received. So they incurred $5,000 of interest on only $95,000 of proceeds from the loan. So this will give us the effective 6-month rate. We then have to annualize it back out to get the effective annual rate of interest on the note. We're just doing the opposite of what we did to prorate the discount. Instead, we prorated it by multiplying the annual discount by 6/12. To annualize the interest rate back out, we multiply it by 12/6. So the effective rate on this discounted note is 10.52%. They incurred the same amount of interest expense as they did on the interest-bearing note, but the amount of cash they got to work with was only $95,000. So it's a higher effective annual rate of interest. So interest payable is one common type of accrued liabilities. We're going to look at another common accrued liability. Remember, an accrued liability is recorded when a company has incurred an expense but the cash hasn't been paid yet. All accrued liabilities will involve a debit to an expense and a credit to a payable. We're going to look at salary, wage, and commissions, the accruals that are done at the end of the reporting period for those employee compensation amounts that have been incurred but not yet paid. One of the common accruals is for unused paid absences. In other words, vacation time or personal time that has accrued as a result of an employee's tenure, but the employee has not used that time yet. A company must accrue those unused paid absences if the following criteria are met. The obligation is attributable to employees' services already performed. So in other words, as employees work, they earn this time off, this paid time off. So maybe, for example, they earn 1 hour of paid time off for every 40 hours that they work. All right, that's an example. 2, the employee can take the paid absence in a later year. The benefit will vest. They will get paid for that time off if employment is terminated. The payment is probable. Okay, who doesn't take their vacation time, right? So we can safely assume that payment will be probable. And the amount can be reasonably estimated. And that is easily done because a company knows how much unused paid absences there are at the end of the year, and they can estimate the amount that they will pay out when the employee takes those absences because they know the hourly or salary rate the employee is earning. When it comes to sick pay, normally sick pay is not accrued unless the policy is to pay the wage even when absences are not due to illness. So a lot of times sick pay can be accrued, but you can't carry it over from year to year. It's not paid out as compensation when employment is terminated, like personal and vacation days are. So unless those same policies apply to sick pay, companies do not accrue any unused sick pay. Let's assume that the employees of Marathon Corp have earned 2 weeks of vacation time per year, and the average weekly pay for employees is $700. As of December 31st, 2021, there are 500 weeks of earned vacation not yet taken. All of the criteria for accrual have been met. We calculate the amount of the accrual by taking the number of weeks of earned vacation time times the average weekly amount of salary to give us the amount that will need to be accrued. So 500 weeks times $700 per week gives us $350,000 of unpaid time off that employees have earned. At the end of the year, that $350,000 has to be accrued as an expense. We are following the matching principle here that says we match an expense to the time period when it has been incurred. So those employees have earned that vacation time in 2021, but they haven't used it yet. It is still an expense that we match to the year when it was earned. So the expense is debited, so this unused vacation time is going to add to the salary and wage expense, but we record a payable for it because it hasn't been paid yet. It's still a liability. Now let's assume all of that vacation time is taken in the next year, but the company was very generous and gave all the employees a 10% increase in pay. So when the employees use that vacation time, they're getting paid at the higher rate. What do we do with that extra $35,000? Right? If the accrual was for $350,000 and wages went up by 10%, the company's going to pay out $385,000 for that vacation time. We simply record the increase as an expense of the current period. So when that vacation time is used, the payable is debited for $350,000. Remember, that's the amount we accrued, $350,000, so we can't debit it for more than its balance. The additional $35,000 is recorded as an expense, and $385,000 is the decrease in cash for the year or for the vacation time. So this is an overview of accrued liabilities touching on the important and common topics of short-term notes payable, accrued interest expense, and accrued salary and wage expense.